If you closely observe historical patterns, you will understand that the year 2026 will not be an ordinary period for those trying to manage capital. We are not just standing on the threshold of another financial report. We are crossing a unique moment in modern economic history, a point of singularity where time compresses and the room for maneuver disappears. This is a period when traditional investment rules are not just broken, they are being rewritten by the power of cycles understood only by a few. Those who are used to looking into the abyss of numbers and seeing the movement of tectonic plates there. Everything I say next is not a vague prediction or chart reading. It is the logical consequence of forces that have already been set in motion and cannot be stopped by pressing a button in a trading terminal. Over the more than 40 years I have spent dissecting markets, studying the anatomy of crises, and observing agonizing recoveries, I have learned one fundamental lesson. History is the only teacher whose tuition fees are measured in lost fortunes. And today, this teacher is giving us clear, almost screaming signals that certain asset classes will turn into deadly traps for your wealth in the coming years. Huge fortunes were destroyed right before my eyes in 1987, 2000, and 2008. Today, I see the same picture. The crowd of investors is making the same fatal mistakes, trying to build tomorrow on the foundation of what worked yesterday. They do not understand that the scenery has changed and the stage under their feet is already mined. The only difference is that this time, the consequences will be far more devastating than anything we have seen in recent decades. We are dealing with an unprecedented level of debt, deep structural changes in the very fabric of the global economy, and a transition of power that happens only once a century. In this world, psychology is more important than mathematics. If you understand the true incentives of the players, you understand their behavior. And current incentives are creating bubbles in places where most do not even think to look. Today, I will lance these boils and show you exactly where these exclusion zones are forming, because the decision to stay away from them will be the most important financial decision of your life. History relentlessly tells us that all great redistributions of wealth follow predictable, almost biological patterns. In 1929, investors believed until their last breath that this time everything would be different. Stocks soared to astronomical heights, fueled by pure speculation that completely detached from the reality of economic fundamentals. The result was a decade of depression that scorched an entire generation. In 1999, the same phrase echoed through the corridors of Wall Street. The internet changed everything. The old rules no longer apply. We believed we were in a new economy until it burst, leaving ruins behind. In 2007, the collective madness insisted that real estate never falls in price and is the safest haven. The logic was primitive. Everyone needs a place to live. And once again, collective arrogance destroyed trillions of dollars. The pattern is always identical. First comes euphoria, followed by a furious denial of reality, escalating into the overconfidence of holding overvalued assets. And finally, the painful awakening arrives. We see the exact same signs today, but the scale of this production has become dozens of times larger. We are no longer dealing with localized bubbles. We are facing simultaneous explosions across multiple asset classes that have been artificially inflated by experimental monetary policy for a decade. Since 2008, central banks have injected over $20 trillion into the global economy. This money did not vanish into thin air. It settled into asset prices, driving them up to levels that defy any logic and common sense. We are living inside the largest monetary experiment in human history. And as with any experiment, there comes a time to record the results, no matter how terrifying they may be. To understand why certain assets will become toxic in 2026, we need to return to basic principles. Any investment is a trade-off between risk and return. When prices rise too high, future returns evaporate, and risk increases proportionally. This is a physical law of financial markets, as inevitable as gravity. There is no such thing as a free lunch, although in recent years we have been led to believe otherwise. Today we see assets offering negligible yields at extremely high risks. This is the exact opposite of what a rational investor seeks. The economy lives in cycles: expansion, peak, contraction, trough, and expansion again. These cycles are as inevitable as the changing of the seasons. There are short-term cycles lasting about 7 years, and long-term ones spanning 50 to 100 years. We are currently in the final phase of a great long-term cycle. This means that many trends we have observed over the last 40 years are preparing for a sharp reversal. When things are going well, leverage multiplies your profits, making you feel like a genius. But when the cycle reverses, that same leverage multiplies your losses with the same efficiency, turning them into a disaster. Today, the debt level in every sector of the economy has reached record highs. Companies, governments, and individuals are deeper in debt than ever before in history. This means that when the cycle turns, losses will be amplified exponentially. True diversification is not owning 5 or 10 different stocks. It is owning assets that react differently to the same economic forces. Most people consider themselves protected, but in reality, their portfolios are 100% dependent on the exact same variables: economic growth, low inflation, and loose central bank policies. When these variables change, and they will change, all these assets will collapse together, exposing the fragility of a system built on the sand of overconfidence. We are entering a zone of turbulence where your survival will depend not on how much you earned last year, but on how quickly you can shed the illusions you considered your property. A generation raised on cheap money mistakenly took a tailwind for their own wings. To grasp the scale of the impending catastrophe, you will have to accept one uncomfortable truth. What you are used to calling economic growth was actually just a side effect of the largest medical experiment on the planet's financial system. We have lived for decades in a sterile laboratory where the laws of gravity were temporarily suspended by political will. Since 2008, the world's central banks have injected over $20 trillion into global veins. This is not just a dry figure from a Federal Reserve report. It is an ocean of liquidity that did not disappear without a trace, but filled every crack in the foundation of capitalism. This money turned into artificial dopamine that made the markets forget about pain, risk, and common sense. We are facing the greatest monetary experiment in human history. And as in any experiment, the phase of observing beautiful reactions inevitably gives way to the phase of obtaining the final results. The problem is that these results will be toxic. For the last 15 years, investors have been literally forced to seek yield in the darkest and most dangerous alleys of the financial world because zero interest rate policies left them no choice. If you wanted to preserve your capital, you were forced to bet it on red, even if the casino was engulfed in flames. This created massive price distortions. Companies that by all laws of logic should have been worth zero turned into multi-billion-dollar giants. When this distortion begins to correct in 2026, the fortunes of those who believed in a perpetual motion machine will evaporate overnight. Money is not just paper or records in a database. It is the equivalent of human energy, time, and discipline. But when you flood the system with trillions created out of thin air, you devalue the very essence of creation. You condition an entire generation to believe that capital is not a resource to be earned, but a right owed to everyone. This cheap credit has atrophied the basic instinct of self-preservation. Today we are recording record levels of leverage in every segment. Governments, corporations, and individuals are leveraged as deeply as never before in the entire history of civilization. We have built a house of cards on top of an active volcano, convincing each other that the lava is just bright backlighting for our success. Inflation, which has long been spoken of as a temporary ghost, has returned to stay. It is not an accidental planning error. It is the only mathematical way out for governments that have accumulated debts impossible to repay with honest money. They have no other way to reduce this debt burden except through the total incineration of your savings purchasing power. This means that the very currency in which you are used to measuring your success turns into an asset with a guaranteed loss. You are holding melting ice in your hands, hoping it will turn into a diamond. When the cycle inevitably reverses, and market physics guarantees this reversal, losses will be amplified exponentially, precisely because of accumulated debt. The leverage that previously multiplied your profits will turn into a noose that tightens harder the more fiercely you try to break free. We are at a point where accumulated debt has ceased to be a financial instrument and has become pure destructive energy, demanding annihilation. Mathematics knows no compassion, and in 2026, it will present a bill that will have to be paid not with numbers on a screen, but with the quality of your life for decades to come. Every dollar printed over the last decade is a promise of future prosperity stolen from tomorrow for the sake of today's comfort. The first trap millions will fall into in 2026 is tech companies that have learned to sell dreams but never learned to generate real profits. If you analyze the technology sector, which has literally exploded over the past 5 years, you will discover something deeply troubling. The vast majority of these companies burn cash faster than a forest fire consumes dry needles. They exist and thrive only because money has cost virtually nothing for a long time. Investors, blinded by the dopamine glare of innovation, eagerly bet on beautiful stories about the future, completely ignoring the gray reality of the present. This is a mass psychosis where faith in algorithms has replaced faith in mathematics. Imagine a restaurant that loses money on every dish sold, yet manages to convince shareholders that it will become the greatest gastronomic empire in the world in the future. As long as liquidity is abundant and cheap, this fantasy can be artificially sustained, creating the illusion of success. But when the cost of capital rises and money becomes truly expensive, the scenery collapses and only naked reality remains on stage. This is exactly what is happening today to hundreds of tech giants. The fundamental problem is that these structures were built for a world with zero interest rates and an endless influx of free capital. In 2026, that world will no longer exist. When interest rates creep up and capital becomes a scarce resource, these companies will suddenly discover they have no sustainable business models. Their entire neurochemistry was optimized for aggressive growth at any cost, not operational profitability. History is merciless. Organizations that cannot internally generate funds inevitably cease to exist, no matter how revolutionary their technology might seem. This is not a matter of opinion. It is a matter of survival in an environment of limited resources. Since 2010, investors have essentially been driven out of safe havens by the low-rate policies implemented by central banks. This forced them to seek at least some yield in assets with prohibitive levels of risk, which birthed monstrous price distortions. Companies whose fair value should have been zero began to be valued in the billions of dollars. In 2026, when this distortion begins to correct under the pressure of economic physics, the fortunes of those who bet on these digital gods will evaporate overnight. Compound interest, as a function of time raised to the power of discipline, now works against them, turning yesterday's assets into tomorrow's liabilities. We are watching hundreds of billions of dollars turn to ash simply because reality is no longer willing to pay the bills for someone's imagination. You must understand, the modern tech industry is not a sector of the economy. It is largely a financial derivative of cheap credit. When the price of this credit reaches a critical point, all these sparkling castles in the sky begin to crash down on their creators' heads. This is the moment of truth, when the difference between value and price becomes obvious even to the most unsophisticated spectator. Those who believed that code could replace capital will face the harshest lesson of their lives. Optimism is a luxury you can no longer afford. The second trap, much more massive and unwieldy, will snap shut in the real estate sector. If you look at price charts in cities like San Francisco, Seattle, Miami, or Austin, you will see growth that has nothing to do with economic logic. In most of these locations, housing costs have tripled in just a single decade. This happened not because real demand grew proportionally, nor because people became 3 times richer. The reason is different. Cheap money made it possible to pay any, most absurd price. Imagine a closed auction where every participant is handed suitcases of money borrowed at 0%. Bids skyrocket simply because no one is using their own hard-earned funds. This is exactly what happened with the American housing market. Low interest rates turned mortgages into a free admission ticket to a club of illusory wealth. People who under normal conditions could never afford a home suddenly gained access to colossal loans. But bigger players entered the game. Institutional predators, private equity firms, entered the market, buying hundreds of thousands of homes across entire neighborhoods, turning them into rental assets. This created a massive artificial demand that pushed prices far beyond what the real economy can bear. We built a system where a roof over one's head became a speculative chip in a game where rules are dictated by printing presses. In 2026, this structure will collide with 3 icy fronts. First, interest rates have already begun their ascent and will continue to rise, making financing unaffordable and sharply reducing the number of people capable of closing a deal at all. Second, millions of homeowners who bought property in recent years did so using adjustable rates. When the time comes for them to reset, they will suddenly find that the monthly payment for their dream consumes their entire income. Third, an entire generation of investors grew up believing that real estate is an asset that appreciates forever. They have no immunity to a real crash. this blind, almost religious certainty will turn them into perfect victims when the correction begins. History knows no exceptions. As soon as an asset is considered absolutely safe, it becomes the most dangerous instrument of capital destruction. For those who bought real estate in the last 5 years in an overheated market, a time of bitter discoveries is approaching. You will find that the amount of your bank debt significantly exceeds the market value of the building itself. Your mobility will be destroyed. You will be chained to an object that has morphed from an asset into a heavy, life-draining liability. Decades of your savings could simply vanish into thin air in a matter of years if your capital is locked in overvalued concrete. In a world where inflation becomes chronic, owning passive concrete in speculative locations turns into voluntary confinement in a financial sarcophagus. Your confidence in tomorrow is just a delay before realizing that you owe the bank more than your world is worth. The true value of an asset is determined not by how much you bought it for, but by how much net energy it can generate in conditions of scarcity. The third, and perhaps the most paradoxical and dangerous trap that will finally snap shut in 2026, is long-term bonds, especially government ones. For 4 decades, bonds were considered the holy grail, the safest part of any investment portfolio, a safe haven where capital could wait out any storm. But safety is not an absolute value. It is a variable that is strictly dependent on the economic environment. In a world where inflation becomes the dominant force, long-term bonds turn into one of the worst asset classes imaginable. This is a silent killer that strips you of your wealth, not by a sudden crash, but through the gradual, methodical burning of purchasing power. Let's dissect this mechanism. Imagine you lend your funds to the government for 30 years at 3% annually. This seems reasonable as long as you live in the illusion of price stability. But if average inflation is 5% a year, the math of your wealth turns into a death sentence. You are literally paying for the privilege of lending your money to the state. This is exactly what is happening today to millions of investors worldwide. They are voluntarily signing a contract for slow financial suicide. After a decade of extremely loose and aggressive monetary policy, inflation has returned, and it has come not as a temporary guest, but as the new master of the house. You must grasp a cynical truth. The governments of leading countries have accumulated debt volumes that are physically impossible to repay with honest money earned through taxes. They have no other way out than to devalue this debt. The only way to reduce these astronomical obligations is to trigger a mechanism of high inflation. This means that the purchasing power of the currency will steadily decline, turning fixed interest payments on bonds to dust. Many market participants still mentally live in the 80s or 90s of the last century, when inflation was under strict control and bonds offered real, tangible yields. They cling to ghosts of the past, failing to notice that the foundation of their security turned to rot long ago. The most frightening thing about this situation is that a massive portion of the demand for these toxic papers is created artificially. There is an entire army of institutional players who are deprived of freedom of choice. Pension funds, insurance companies, and commercial banks are bound hand and foot by government regulations that oblige them to hold a significant portion of their assets in safe bonds, regardless of their actual investment appeal. These entities are forced to buy tickets on a sinking ship simply because those are the rules of their charter. This forced demand keeps prices artificially high, giving the average person an illusion of stability. But it cannot change the fundamental economic reality. This is a financial theater where the audience and actors are locked inside a building that is already engulfed in flames. In 2026, when inflation becomes persistently high and central banks are forced under the pressure of circumstances to raise interest rates to levels that seem unthinkable today, holders of long-term bonds will face a catastrophe. The drop in bond prices as a function of rising yields is a rigid mathematical certainty that leaves no room for hope. Those who sought protection for their future in government debt will discover that they funded their own ruin. If you are an American between the ages of 40 and 80, these tectonic shifts will hit you directly, destroying your plans for a peaceful retirement and turning your savings into phantoms. Most pension plans today are built on the hallucination that stocks will return 7 to 8% annually and bonds 3 or 4%. These numbers made sense over the last 40 years, but they are absolutely irrelevant for the next decade. For those who have already retired, the situation becomes critical. You simply lack the time resource to recover from losses measured in decades of your labor. If a significant portion of your capital is locked up in government debt obligations, you will find that decades of strict discipline and savings can be annulled by a stroke of the inflationary pen in just a few years. In a system built on debt, the creditor is always a hostage to the debtor's reliability. But when your debtor is a state that holds a monopoly on the printing press, the concept of reliability merely becomes a matter of political expediency. You have entrusted your future to a system that survives by slowly robbing you through the invisible tax of inflation. Those who believe that bonds will save them during a period of turbulence are making the most fatal mistake of their lives, mistaking a debt noose for a life preserver. The state never declares default loudly. It does so in a whisper, through every price tag in the store, which reminds you that your savings are worth less with every breath you take. A bond in the era of the Great Devaluation is not a promise of capital return, but a guarantee of its confiscation. True understanding of the moment comes when you stop fighting the inevitable forces of economic cycles and start using their gravity to your advantage. Great redistributions of capital always occur during periods of transition, and this is not a time for panic or despair, but a moment of absolute clarity for those who can look past market noise and human emotions. Most investors lose their fortunes during such periods simply because they cling too long to strategies that bore fruit in the past, hoping that reality will adjust to their expectations, rather than adapting themselves to the new reality. Temporary wealth is built by betting that current trends will last forever. But prosperity calculated for a decade is created upon the realization that any trend, sooner or later, reverses. The most successful players in history were not those who perfectly timed their market entries. They were the ones who understood fundamental principles and positioned themselves accordingly. There are specific strategies capable of protecting and even multiplying your capital during this turbulent period that we call 2026. True diversification is not owning 5 or 10 different stocks that are all equally dependent on cheap credit and low inflation. It is owning assets that benefit from fundamentally different economic conditions. In an environment where inflation becomes chronic, you desperately need instruments that preserve or increase their value when the purchasing power of the currency tends toward zero. We are talking about humanity's basic needs, the demand for which will not disappear under any circumstances. Energy, precious metals, and agricultural products historically become the foundation of prosperity during inflationary storms, as they represent not a speculation on the future, but an urgent necessity of today. Your focus should be on companies possessing real natural resources or brand power that allows them to pass rising costs onto the end consumer. These are regulated utilities, energy giants, and producers of essential goods with colossal market power. Infrastructure, transportation, basic telecommunications, and life support systems will function regardless of the state of the stock market, providing a flow of real cash to companies with proven business models. Even in the real estate sector, which I called a sarcophagus, zones of life exist. If you know how to pick, while megacities suffocate from speculative paralysis, opportunities open up in smaller regional markets that have not experienced the artificial boom and where prices still reflect real economic value. Look for locations with a diversified economy that do not depend on a single employer or trendy industry, where real estate objects are capable of generating pure income based on solid fundamentals. However, the most difficult and intellectually superior decision in high-risk environments is often the decision to stay out of the game. You must reserve a significant portion of your wealth in cash equivalents, even though inflation will methodically chip away at their value. Losing 5% a year to currency devaluation is a negligible price to pay for the ability to avoid a 50% collapse during a massive correction. Having free capital at a time when everyone else is forced to sell quality assets for pennies turns you from a victim into a hunter. You shouldn't feel pressured to be fully invested every single second. Your job is to wait for obvious opportunities where the risk is minimal and the return potential is enormous. Accept it as a mathematical fact that we are entering an era of prolonged inflation and position yourself accordingly. If you have debts, your priority should be converting them to fixed interest rates while it is still technically possible. When central banks are forced to radically raise borrowing costs to save the system from overheating, your debt burden mustn't turn into a noose. A portion of your wealth must be in things that hold intrinsic value, independent of the will of bureaucrats and printing presses. The financial landscape is changing at a terrifying speed, and the dogmas that worked for decades are becoming a one-way ticket. Do not limit your horizon to just stocks and bonds. You must understand the mechanics of commodities, currency pairs, and inflation hedging instruments. Historical patterns repeat, but they never copy each other exactly. The deeper you understand past cycles, the better your chances of navigating future storms. The market is always larger and more complex than any individual, and acknowledging this fact is your first step to preserving your capital. Humility in the face of economic laws preserves fortunes where arrogance destroys them. When I say that you should never invest in certain assets, this is not fortune-telling. It is pointing to mathematical reality. You cannot forever prop up the price of an asset based on scenarios that are physically impossible in reality. This is a matter of economic physics, not personal opinion. You may believe that this time, the laws of risk and return have been suspended. But history proves that such a bet always turns out to be a losing one. Every great correction opens extraordinary opportunities for those who are prepared. The world's best companies will become available at prices we haven't seen in decades, and real estate in premium locations will once again begin to yield attractive real returns. Bonds will again become a sensible instrument when their yields begin to reflect inflationary reality. But these fruits will go only to those who manage to save their capital during the turbulence of 2026. Economic cycles are like the seasons. You cannot cancel winter, but you are obliged to prepare for it. We are approaching an economic freeze after a long and unnaturally hot summer. Those who meet it fully armed will not just survive, they will become the architects of wealth in the next era, which will inevitably arrive on a more solid foundation. Wealth in 2026 is not created. It is redistributed from those who believe in miracles to those who understand the physics of cycles.